I want to keep this market conversation going. I want to bring in Michael Tiedemann, CEO and founding partner of Tiedemann Advisors. Michael, so we're seeing the bond yield spiking again today. A lot of folks keep saying that these moves are essentially transitory. How concerned, however, should investors really be about these rising rates?
Well, economically, it's sensible. Financially, it's dangerous. And what I mean by that is you clearly have nominal GDP in this calendar year that could, approach 7+%. So 1% Treasury yields really is completely, dislinked from that. And what you're really seeing and what you've been seeing over the last few months is it took a very long time for not just the 10-year, but cyclically sensitive stocks, bank stocks, commodities, et cetera, to begin to recognize that there may be a paradigm shift. Financially, it's dangerous because all asset pricing sets off of that base rates and off of the 10-year curve, so corporate bonds, and obviously the discount rate that applies to equities.
I do want to mention, of course, the Dow is being boosted by financials. That sector right now up about 2%. I do want to talk about tech, however. NASDAQ still down over 1.5% right now, and tech continues to be really hard hit from some of these moves. I'm wondering if, however, you view this as a buying opportunity for investors, especially there's a lot of questions that remain about valuation in the tech sector and also of the strength of that sector this year. A lot of folks saying tech is probably going to be under pressure throughout 2021.
Well, there are a couple dynamics at play. First of all, in general, when you have rising rates, it will benefit or should benefit those businesses that naturally generate current free cash flow. And over the last year, really over the last few years, there's been the market has set a huge premium for the companies that, generally speaking, emerging tech businesses that are very promising, that have the possibility of great future cash flows. And there was a huge premium allowed to expand for that. That is now being challenged. The opposite is true with businesses that are cash generative, that have good balance sheets, that are quality growing businesses, maybe not at the same clip, but ultimately are cash generative. So they'll ultimately be less sensitive. The banks are more related to the steepening of the yield curve and the profits that they have the ability to generate. But tech, the other thing is tech is such a broad set of companies. In many ways, tech represents the economy as the businesses are influencing huge segments of businesses and corporations. But when you look at a company like Apple, huge cash flow generation, that doesn't, the 10-year movement really shouldn't impact that business versus another company that is yet to generate profits trading at a large multiple.
You're not wrong there. Almost every single company, I think, labels themselves a tech company now. McDonald's, Domino's, all tech companies. What are you liking then? What sectors do you think, or even perhaps specific stocks that some folks should really start paying attention to going forward, especially as we see some of this volatility?
Well, so we, in general, always have, because we're really long-term asset holders for the vast majority of our clients. So our focus will always be on high quality risk assets or growth assets. In particular today, we still think, even though there's been great performance in the last few months, we still think the greatest linkage to a US recovery is the mid-cap space. So a lot of the more domestic oriented, and you could say the upper small cap space, although that has really recovered sharply in the last 4 or 5 months. But those businesses have real momentum. They have the benefit of a sharp and quickly recovering economy as we go into the end of 2021 and into 22, 23.
I want to pivot now to those jobless claims. There was a spike to 770,000, also higher than had been anticipated. I know it is only 1 week, but what are you anticipating, at least when it comes to the labor market going forward?
Well, the labor market, the headwind the labor market has is the time it will take for small businesses to recover and begin rehiring. So broadly, as you look across the country, and we've expected this in the last 6 months, just think about the variances state by state in terms of whether or not restaurants are allowed to be open or movie theaters or what have you. And generally, they've been closed, but there have been pretty wide variances. So small businesses that were sort of holding on in many cases oftentimes will right size their business and wait. So there's that dynamic. But we were always expecting an uneven recovery, a lumpy recovery. You could see the opposite, where we could have in 2, 3 months from now, a job number that blows out to the upside. That would be completely unsurprising to us.
Now, we had that FOMC meeting yesterday. They left interest rates unchanged. This is something that we were talking about on yesterday's program, how essentially that the Fed is going to have to pivot, from helping an economy that was struggling to now dealing with an economy that is quickly strengthening. I'm wondering when you think that pivot might happen, and how bumpy do you think it might be for investors when it does?
Well, first of all, what the Fed did last year in terms of stabilizing the bond market and ultimately the equity markets was really never seen before. So how that unwinds is going to be a challenge, and doing it quickly is, I would say, virtually impossible without an accident. So we don't think that their verbiage will change much. They know the damage that has been done in much of the real, or many sectors within the real economy. They also are trying to balance the speculative backdrop of asset pricing that you've been seeing. They've got a tricky job. I would say that they likely will not raise rates until the time frame that they've set out, and they will likely do it slower. But what they can do in the interim, and they obviously have the headwind of the Treasury market moving now on its own right, so that will do some work for them.
All right, Michael Tiedemann, CEO and founding partner of Tiedemann Advisors. Thanks so much for joining us today.